Today we will be discussing one of the most important topics called Accounts Receivable and how this item plays a role in recognizing an asset and revenue. Most importantly, we are going to discuss here is: when do we recognize an accounts receivable? What are the terms for FOB shipping point and FOB destination? Those terms which actually come in revenue recognition also. But at this moment, we will be discussing what do they actually mean. Accounts receivable. Accounts receivable is an asset that represents customers' promises to pay for goods or services delivered, and the company usually gives some credit period, that is 30 or 60-day net payment terms to another entity elsewhere. The firm will lose its business and will lose its revenue in order to catch the customers or attract customers. Normally, when sales are made on account, there is always a possibility that the firm may not be able to collect the full amount of its accounts receivable, and automatically the uncollectible amount will be transferred to the bad debts account. There are several ways to account for the resulting bad debts expense. Accounts receivable always should be reported at net realizable value, NRV. Assume all discounts will be taken and receivables and sales are recorded at their net amounts. It follows the matching principle. According to US GAAP and IFRS, US GAAP refers to allowance accounts as allowance for bad and doubtful debts. IFRS refers to allowance accounts as provision, whereas US GAAP follows the matching and conservatism method. IFRS violates the matching and conservatism method. These are the most important terms to remember and understand. Allowance method. A firm estimates the expected uncollectible amounts from all credit sales or from all outstanding receivables. The allowance for bad and doubtful accounts is subtracted from accounts receivable to determine the net realizable value of the receivables. Bad debt expense is reported as an operating expense on the income statement. Whereas under the allowance method, there are several ways to estimate and recognize the expected future bad debt. Bad debt is a function of credit sales. The journal entry would be: bad debt expense, account, debit. Allowance for bad and doubtful debts, account. For example, a firm total gross receivables $100, bad debts $10, and the net accounts receivable would be $90. Under the allowance method, there are two types of recognizing allowance methods. Number 1, percentage of sales method. Number 2, aging of receivables method. Let us understand what is percentage of sales method. This method assesses the historical relationship between actual bad debts and accounts receivable over time. Bad debts will be calculated as credit sales multiplied by estimates of uncollectible percentages of credit sales. For example, if a company has $100,000 in accounts receivable at the end of a period and estimates that 5% of receivables will result in bad debts, The desired ending balance in the allowance for doubtful accounts should be $100,000 multiplied by 5%, $5,000. Thus, the net accounts receivables would be $100,000 minus $5,000 is equal to $95,000. The journal entry would be bad debt expense, account, debit. Allowance for bad and doubtful debts, account. Hence, this is purely an income statement approach, and it emphasizes matching. Any balance in the allowance account is ignored to calculate bad debt expense. Aging of receivables method. It can be used to categorize accounts receivable by the length of time the debts have been outstanding. That is, like 30 to 60 days old, 60 to 90 days old, and 90 to 120 days old, and so on. The older the debts are, the higher the estimated percentage of doubtful accounts. Bad debts is a function of accounts receivable collections and will be calculated as outstanding accounts receivable multiplied by estimate of uncollectible percentage of accounts receivable. The journal entry would be bad debts expense, account, debit. Allowance for bad debts, account. Like this, each company might have a different policy for providing bad and doubtful debts based on the age of the receivables. Generally, nothing is provided for current debts the moment it crosses 30 days, which is actually a normal credit period. Then some firms will provide maybe 5%, or it will be specified in the question how much is required provision. Let us say some debts have moved to the 30 to 60 day range, that is over a 30-day. And let us assume here $200,000 multiplied by 5% would be $10,000. In this method, we focused mainly on the balance sheet, and this method is allowed under USG AAP, which emphasized asset valuation. Now let us understand and get familiar with the terms of FOB shipping point and FOB destination. If the shipping term says FOB shipping point, then the seller takes all the responsibility to make the goods ready for shipment. And once the seller loads the goods onto the carrier, it might be a ship or plane, or might be a truck through road transport. Once the seller ships the goods and gets the transport receipt, which might be a bill of lading in case of a sea transport, airway bill in case of air, and truckway bill in case of road transport. The moment the seller gets that receipt and transfers the receipt or transmits it to the buyer, from that point onwards, it becomes the buyer's property. So until the seller readies the goods for shipment, it is the seller's responsibility. And once the seller loads the goods onto a carrier, it becomes the buyer's responsibility. Then it becomes the buyer's responsibility to transport the goods from that point to his warehouse. On the way, insurance, freight, etc. would be the buyer's responsibility, and the risk of ownership would be transferred to the buyer. At any point of time after the shipping point, if there are damaged goods, the buyer will be bearing the loss of it. If 31st December was the accounting period for the buyer and the goods were shipped on, let us say, 22nd of December, but reached the buyer's warehouse on, let us say, 10th of January, the buyer can account for it having goods in transit on 22nd of December. So the 31st December financial statements would include this inventory and a corresponding liability. This is how the accounting is done for FOB shipping point. If the shipping term says FOB destination, if the shipping point says FOB destination, the goods don't exchange title. It doesn't become the buyer's property until it reaches the destination, which is the buyer's warehouse. If the goods are shipped, let us say on 22nd of December, and the buyer's accounting period is 31st of December, but the goods reach the buyer's warehouse on 10th of January. On his 31st December financial statements, the buyer will not record the inventory as well as the corresponding liability. He will account for it only when it reaches his warehouse, which is 10th of January of the next year. So it is not the buyer's property until 10th of January. The title of goods has not been exchanged to the buyer, and the risks and benefits of ownership get transferred to the buyer only on 10th January.